and welcome to this special curtain raiser to the RBI monetary policy. As you may be aware, the CNBC TV18 Citizens Monetary Policy Committee had voted 4:1 that the repo rate be cut by 25 basis points by the RBI. However, after our citizens panel met and voted, the market has been subject to a couple of important developments. First, the country's largest bank has cut in a never-before move the savings deposit rate by 50 basis points to 3.5%. It's a seminal move as it immediately lowers the cost of a large chunk of savings. Secondly, recent growth data have been particularly painful. Core sector growth for June came in at a 14-month low of 0.4%, while the Purchasing Managers Index of Manufacturing for July came at an 8-year low of 47.9. Third, India's stock indices, quite contrary-wise, have been touching new highs every day during the last 2 or 3 weeks. So what should the Reserve Bank do? I have with me A. Prasanna, the Chief Economist, ICICI Securities PD, Manish Vadawan, MD and Head Interest Rates at HSBC, and Rajkiran Rai, the Managing Director and CEO of Union Bank. Gentlemen, before we start, do hear out the verdict of our Citizens MPC, and I would like to know from you if things have changed. First up, what are you expecting by way of an action? That's a cut from Sonal. Somiran? That's a cut as well. So 2 votes cut. Shaumyo? That's a cut as well. And Sajid, cut. Chairman, in the past, you've called it right, even when you were in a minority. What's your call? Dr. Sen, pause. Okay, so it's 4 members opting for a cut, but the chairman opting for a pause. Now, to the extent of the cut, please write whether you're expecting 25 or 50 or 75 basis points. Sonal, you go first. How much of a cut? 25 basis from Sonal. Samiran, 25 basis. Shaumyo, okay, 25 basis cut. Sajid as well, 25 basis cut. I will not put that question to Dr. Sen because he has called for a pause. Well, a final question to all of you. For the period of this year, how much of a cut, including August 2nd, how much of a cut would you expect? Dr. Sen?
Well, over the course of the year, I would expect something like 50 basis points to be cut. I think if things go as we have discussed, I think the space is there. But I think the critical factor that we have to actually watch out for is what is the position of the banking system vis-a-vis the capital markets.
Okay.
And that's a dynamic which we are unsure of at the moment.
Okay, so 50 basis over the course of the year. Samiran?
50 basis point for us as well.
Okay. Shaumyo?
Yeah, 50 basis point for us, but we would be also looking into the monetary policy commentary very closely.
Sajid?
I'd say 25 to 50.
Okay.
25 is a baseline, 50 at most.
All right. Let me welcome Rajkiran Rai, Mr. Manish Vadawan and A. Prasanna. Mr. Rai, you go first. Well, the biggest bank has already moved with a 0.5% cut. Does this not impact you? Would you not want to join? Irrespective of what the Reserve Bank said tomorrow, is a savings rate cut from you a given?
Yeah, good evening. Savings rate cut may be expected, because the leader has already moved. So hopefully most of the banks may follow the direction what SBI has set actually. Anyway, our ALCO will meet after the RBI meet. So we'll take a call on that. Meanwhile, we are also expecting a 25 basis point cut tomorrow in the policy. So coupled with that, we'll take a call. But despite the what RBI call is on the rates, so a MCLR cut may be expected because of the expected cut on the savings deposit. Because the advantage of savings rate cut is the impact is immediate.
Yes.
Because when we reduce deposit rates, it is on the incremental deposits.
Absolutely.
Whereas savings, it immediately gives me a benefit because it is on the existing deposits.
Absolutely.
So I think this, because it has got a direct impact on MCLR, so despite whatever call RBI takes, some adjustment in MCLR may be expected.
Absolutely, sir. That's the point. You know, the extent of the cut, 0.5%, the amount of money, it's almost 1/3 of the total deposits of the banks concerned. And 3, the fact that it is on the historical pool of savings and not just on incremental makes this an elephant in the room which the Reserve Bank cannot wish away. So, Prasanna, that question to you. Irrespective of what the Reserve Bank does, the banking system or a large part of it is going to make 1/3 of the money cheaper. Therefore, can there be a situation when the Reserve Bank talks otherwise? Does it not have to follow the market?
First of all, I think it's a very loose way of describing the banking system as market.
Okay.
In the sense it's not a perfectly competitive sector in any
Fair
case.
point.
That is just a pedantic point, I would say. But anyway, coming to your question, see, I mean, of course, it depends. I mean, the banking system or the largest bank might have a different assessment than the central bank about inflation and about savings in the system. It is always possible. I think in the short term, there can be divergent opinions. So I wouldn't say just because of this reason the RBI has to follow suit. In any case, our view is RBI should cut interest rates by 25 basis points. Or rather, I should say the MPC should cut interest rates by 25 basis points, purely because inflation is undershot there as well as market expectations. And by March 2018, it should be broadly around 4%, which is the target. And therefore, it warrants an adjustment in the policy rate.
Would you expect a change in the difference, the spread between the MSF repo rate and reverse repo rate? I agree, it was only the previous policy that it got changed. But could there be an argument that the curve could be steepened and therefore you revert back to 50 basis?
I don't think so. I think the reason why, for example, the reverse repo rate was changed and therefore the spread between repo and reverse repo was narrowed was because of excess liquidity conditions were actually vitiating money market rates. And the MPC, or rather the RBI, wanted to make sure that the overnight rates stay in the corridor or stay as close to repo rate as possible. That situation has not changed. I think the process of draining out excess liquidity is far from complete. So at this point of time, I don't think they will change the spread between repo and reverse repo again. Okay.
Well, Manish, what would you expect will be the impact on the markets? Do you think markets have already factored in 25 basis? How are they likely to move after the policy?
Lata, I think you had a valid point that markets have factored in a 25 basis point cut tomorrow. And they are reflective in the yields, whether it is treasury bills or the long end bills or the corporate bonds. But I think the market is looking beyond the rate cut itself, which is, I think, the stance. If there is any change in that, they moved from accommodative to neutral in February. With this kind of a rate cut, is it going to be a change in stance back to accommodative, or they stay neutral and just cut rates? And the second important thing is, what do they do on the liquidity measures? Like they have started announcing the OMOs in the month of July, and today only the MSS limit has been increased from 1 trillion to 2.5 trillion. These are the factors which would be important for the market to look forward to tomorrow. I think rest is 25 basis point as everybody's putting, put it on the table and it's on the cards already.
Okay, I'll come to the MSS and the liquidity point in just a bit. But first, for the other big elephant in the room, which is the way in which we have seen stock prices rise, a huge asset inflation. There are a lot of experts who believe that the manner in which NBFCs have been able to raise money, the people to whom they lend, the way in which mutual funds, especially debt mutual funds, are investing in both listed and unlisted companies, are all perhaps indicating of a little bit of froth. Do you think the Reserve Bank will have to, warn of excesses in some fashion or the other, Manish? Could it?
Lata, these, whatever you mentioned just now, these factors are pretty important, and we have seen that the levels of borrowings by these NBFCs, where the mutual funds are lending, have come down very, very sharply. I think it's a combination more of the excess liquidity in the system since November 2016 because of demonetization. But I really don't. I really don't have an answer to this. That whether central bank would be very keen to go into these kind of nitty-gritties to see whether it is leading to some kind of a froth. And I don't see a froth building up. Yes, definitely, it's a new paradigm because the kind of borrowers you're talking about, they have not been able to borrow at single digits, and now they're talking about 8.5%, or CPs being issued at 6.25 or 6.5. But I don't think that there is a froth kind of an element in these kind of things. It's more a manifestation of what liquidity is doing to the system. The credit has not grown enough in this fiscal. As you know, the numbers are available, and mutual funds being dumped on, in terms of the deposits, what they're getting, the funds they're getting, they're chasing assets. And in that kind of process, definitely they're looking at lower credit and some kind of assets which traditionally they have not been in. So I think that's the case, but I don't think it's a froth anywhere in financial markets, especially in the debt markets, and I would reserve my comments on equities.
Okay. No, froth, of course, is perhaps a loosely used word. My fear only is whether the Reserve Bank would think a warning is in order. Mr. Rai, do you expect... Again, I'm just throwing my mind back to, I think, 2004, if it was, when the Reserve Bank... at that time, of course, it was in a hiking cycle. It thought it had bottomed out. It hiked rates, but more importantly, it raised the margins on capital market exposures. It raised risk weights, if I'm not mistaken, on loans against shares. Would you expect any such what you call macroprudential measures from the Reserve Bank?
See, the capital market is not driven by bank funding anymore. So I don't expect this will be any area of control which RBI has now. So I don't think, I'm not expecting any action from that side. It is totally driven by many other, the funding which is coming either by mutual funds, SIPs or FII investments. So it is not definitely bank funding which is a factor in this capital market.
No, I completely agree with you. It's not bank funding, but... because probably bank rates are not all that lucrative, there is a march of funds from perhaps fixed deposits of banks to mutual funds. And they could be to fixed income mutual funds, which after all are more in pool than equity mutual funds. Prasanna, do you think that there could be some kind of macroprudential rules or warnings from the central bank?
Well, first of all, I'm not sure. If you really worry that, or if RBI is worried that there is a bubble in asset markets, then where is the counterpart of that happening in real sector? Typically, if you see asset markets, when you see froth in asset markets, it also has a real sector implication. If you look at US example, when the housing boom was happening, it was making a material contribution to growth, and there was a credit growth also. Even in India, I think prior to 2008, I think that was the scenario. Of course, not in 2004, but in the later stages of that boom, there was massive credit expansion by the banking system. Today, that is not the situation. And in any case, I think if really the MPC or the RBI is worried, like the way you pointed out, that excess money is flowing to some of these sectors, I think they have to look at their own actions vis-a-vis liquidity. From September onwards, or rather from October 2016 till now, the interest rates have not changed. What happened was demonetization, and after that excess savings moved into the banking system, and RBI didn't take any steps to tackle excess liquidity. And we have been saying that probably that was a mistake by RBI. They have been too slow in addressing the liquidity situation. So perhaps they should look at their actions. I think mere words will not suffice. If they're really concerned, I think they should speed up their liquidity draining measures.
Okay. Well, it is quite possible that primarily to drain the liquidity, the Reserve Bank has now armed itself also with a higher limit of market stabilization bonds. That question on what the Reserve Bank might do to liquidity after this break with our guests.